The top business stories live from the Sky News City studio. Scrapping the tourist tax. Campaigners urge Jeremy Hunt to restore VAT-free shopping for visitors. I'll be joined by the fashion designer Sir Paul Smith. The UK's unemployment rate is revised down for the 3 months to November last year. And the UK accessories brand Geiger announces the most profitable month in its history. Good morning, this is Business Live with me, Ian King. The Chancellor, Jeremy Hunt, has reportedly asked the Office for Budget Responsibility to review the so-called tourist tax, the decision in 2020 to scrap VAT-free shopping for international visitors to the UK. Business leaders have argued since that there needs to be a U-turn, arguing it puts the UK at a disadvantage compared with other shopping destinations across Europe. A letter signed by more than 400 business leaders calling for change has today been delivered to the Treasury. Well, one of those signatories was the fashion designer Sir Paul Smith, who joins me now. Sir Paul, welcome to you. What made you want to sign this letter?
As somebody who has lots of shops, but not just that somebody who's very proud of our country, and the fact that there's a lot less people been coming to the country, especially to shops, sales, restaurants, museums, and so it's something that real shoppers used to come. I mean, about a third of our business was tax-free shopping. So it's about income and money, but it's also about country as well.
I mean, it would cost around £2 billion, apparently, to restore VAT-free shopping. I mean, the Treasury at the time, someone said this is basically a bung to millionaire Chinese tourists to get a luxury handbag. I mean, there is something in that, isn't there?
Yeah, of course, a lot of it was to do with shoppers coming, but now in all the other EU countries, it's still available. So those people that you've just described are still having the opportunity of buying for 20% off or whatever it is in each country. And so I don't know, you know, from a point of view, you know, what about all I mean, I have 500 staff here. If we're doing less turnover, then, you know, maybe I can't have 500 staff. But it's people like in my street, you know, where my main shop is. It's a hotel, and he's signed the letter. Rocco 40 and BAA have signed the letter. So it's not always necessarily about you know, rich shoppers coming to buy cheap handbags. It's the fact that when they're here, they do spend money in our great cities. That's it.
But suppose someone, for example, from Newcastle comes down to London, they spend a few days here, they stay in a hotel, they do a bit of shopping in the West End, they have to pay 20% VAT. Why shouldn't overseas visitors?
I can't argue with that aspect of it. All my passion is the Royal Academy, the National Gallery, the lovely hotels, you know, all the European hotels, the European museums I've seen come back after the pandemic, and we haven't. So it's not just I think you're twisting it to do with cash and to do with millionaires. It's not just about that. It's about bringing people to the country and seeing all the fantastic things we've got.
Can you put a figure on the extent to which your sales have been hit? I think you said they were down by about a third.
Yeah, I don't know what that was in actual cash terms. I might have it written somewhere, but I don't think I have. No, but I mean, it's obviously it's difficult to know whether those people are still coming and buying from you. But certainly in actual terms, it's a third less than it was before.
And has the composition of visitors changed significantly, to the overseas visitors to your stores?
Definitely. Well, just visitors from overseas dropped enormously for obvious reasons with the pandemic. And then, of course, the way people shop has changed enormously as well. And it's taken for people to come back into shops because so many people shop online. The world has been so topsy-turvy for the last 4 or 5 years. I mean, Brexit's without going down that route, but I mean, it's been an absolute total nightmare for a company like mine that sells in over 60 countries around the world. So, you know, can you bring anything else to, you know, not help us run a business still independent after 50 years, you know?
So are you quite optimistic, given these reports at the weekend, that the Chancellor's asked the OBR to look into this issue?
Well, lots and lots of letters, and so this one's got through. And so that arrived. That was sent last Tuesday, and it looks like we've got a bit of contact at last. And of course, with the possible elections this year, then who knows? But yes, please, we'd like it back.
All right, Sir Paul Smith, good to talk to you this morning. Thank you.
Cheers. Thanks a lot. Bye.
Now, the accessories brand Geiger said today it enjoyed a record Christmas trading period, with December the most profitable month in the company's history. Geiger, which is owned by the private equity firm Cinven and whose handbags are owned by celebrities including Julia Roberts and Jennifer Lopez, also reported sales of £329.5 million for the 12 months to the 28th of January last year, up 31% on the previous year. Underlying operating profits rose by 49% to £30 million. Well, with me now is Neil Clifford. He's Geiger's Chief Executive. Neil, your December sales were up 15% on the previous year. How much of that was price and how much volume?
Well, price was about the same, actually, Ian, and volumes were massively up. So, yeah, we were super happy. We were super happy.
Now, the figures that I just quoted for the financial year to the end of January last year, I assume, judging by how you did in December, you're going to comfortably beat them for the financial year just ended.
We will, absolutely, yeah. Sales for the whole year will be up and profits will be well up. We don't announce those later. The reason why we've announced these results now is we've also ploughed £1 million into our new academy that you'll see the sign behind me. You remember we spoke in almost 4 years ago in the launch of the pandemic on that 23rd of March, and we've been very busy since then, mainly building an educational school in our head office.
Very good to hear, and I do remember that conversation well, Neil. You opened 8 UK stores last year. You're planning a further 5 in the US this year. How does it balance for you these days between online and physical retail?
We're about 40% digital, actually, so nice and healthy. We love digital. We love our stores. We just opened a new store on Oxford Street, actually, which we're super happy with. Our most profitable store, and only been open 5 months. So, no, we love both. Actually, you need to just follow the customer, to be honest, don't you? Wherever she or he wants to shop, that's what you do. The North American stores, we've already opened 3 in Mexico. And actually, Monterrey in Mexico is already our #2 store in the world. So, yeah, globalization for us, the transformation of the company really since that 23rd of March has been, we've been very lucky. We've been working very hard, but it's been successful. So we're really pleased.
The sales mix has also changed quite appreciably as well. I mean, originally it was a footwear brand, but I think handbags is now the biggest selling single category for you.
It is. It is. We've done a brilliant job of handbags. It's been an overnight success. Took us about 12 years, in fact. So, no, we're very happy. America's almost 70% handbags, and North America is our #1 market now. So we finally managed the transformation into a global brand, which, you know, I've been here since 1996. So it's taken us some time, but we're really happy with where we've got to. And as I mentioned, we can plough some of those profits back into helping some young creatives with a free educational service, which is now live in our building here.
Good to hear, Neil. Before I let you go, I mean, you were another one of the signatories to the letter that's gone to the Treasury today on VAT-free shopping. Are you fairly optimistic that the Chancellor's going to reverse this policy?
Well, I think the Chancellor's quite smart, so I hope so. I think it was for many reasons, as you were speaking to Paul Smith. It was a negative move. You know, Brexit was supposed to bring us to be a global Britain, and then we closed the doors. So I hope I hope Jeremy is as smart as he sounds, because it would be very helpful for UK GDP, frankly.
All right, Neil, we have to leave it there, I'm afraid. Good to talk to you this morning. Thank you.
Thanks very much. Cheers.
Some other news stories for you now. The UK's unemployment rate was lower in the second half of last year than previously thought, the Office for National Statistics said this morning. The ONS revised the unemployment rate for the 3 months to November to 3.9%, down from the previous estimate of 4.2%. But the so-called inactivity rate, the proportion of people of working age not in work and not looking for work, was raised up to 21.9% from 20%. The CBI said this morning it settled legal action brought against it by its former Director General. Tony Danker was dismissed in April last year following allegations of personal misconduct. He subsequently claimed he was carrying the blame after a number of other allegations were made about events at the employees' organisation that predated his arrival. The CBI reiterated today that Mr Danker was not associated in any way with those allegations. Boeing said last night it will have more work to do on 50 undelivered 737 MAX jets after its supplier Spirit Aerosystems discovered 2 misdrilled holes on some fuselages. Boeing, which has been under intense regulatory scrutiny since a door plug blew out of a 737 MAX 9 jet operated by Alaska Airlines last month, said that the issue could delay some deliveries in the near term. An interim report is expected to be published this week by investigators looking into whether the bolts on the Alaska Airlines plug were merely missing or merely badly fitted. Shares of Vodafone fell by up to 2% this morning after the mobile and broadband giant admitted to a slowdown in sales growth in Germany, its biggest market. Vodafone said its sales grew in the country by 0.3% in the 3 months to the end of December, down from 1.1% in the 3 months to September. It blamed the loss of 133,000 customers in the country after it put up broadband and pay TV prices. The company also confirmed it was in active discussions about a deal in Italy, where its Vodafone Italia business is the second biggest mobile player. And the trading platform CMC Markets has announced plans to cut 200 jobs, representing 17% of its workforce. The news comes after CMC launched a cost review in November last year, which it said was aiming at driving efficiency through its global operations. CMC said today cost reductions have been primarily achieved by merging support functions across multiple business lines, streamlining reporting lines and automating processes. The shares, I can tell you, are currently ahead by some 14%. Well, we start with the currency markets today. On the foreign exchange markets, the dollar is currently trading at a 2-month high after Friday's bumper job figures. Sterling off 0.2% right now against the greenback. It's unchanged against the euro, the single currency off 1/3% against the dollar. Friday evening, strong finish on Wall Street on the back of those job figures, during which the S&P 500 hit a fresh all-time high, was followed by mixed trade overnight in the Asia-Pacific region. Shanghai finished down by more than 1% on disappointing data from the services sector. Well, in Europe, stocks have been a bit mixed this morning. The IBEX in Milan letting the side down, in Madrid, letting the side down a bit there. Talking points today include Atos, the French technology company, is off 28% in Paris after it dropped plans for a new equity issue. Here in London, the FTSE 100 is in positive territory, up nearly 0.5%, with support coming from the big US dollar earners, including GSK, HSBC and Unilever. In percentage terms, Land Securities is one of the standouts this morning. That's on the back of supportive broker comment, while to the downside, Airtel Africa remains unloved after last week's trading update. Outside the FTSE, Watches of Switzerland is up 3.25% on hopes VAT-free shopping may be restored for overseas visitors. As for the oil price, well, that fell sharply on Thursday and Friday. It's been a bit drifty this morning. Barrel of Brent crude currently trading at $76.98 a barrel. That's off nearly 0.5% on the session. Joining me this morning is Russ Mould, Investment Director at AJ Bell. Russ, good to see you this morning. We should start with China, another big sell-off.
Yeah, the small cap stocks were particularly hard hit. The CSI 1000 index, that was down 8% at one stage, but the Shenzhen index, which is domestic companies, that was down 4%. Shanghai was down 1%. I think it's just ongoing worries about the economy. I think there were hopes that the Chinese authorities, besides banning short selling, would come in with a stock market support package. No sign of that yet, and investors waiting to see what signs they'll offer on the economy as well.
And this is in spite of the fact that the authorities have been intervening to try and prop up the market.
The national team, so-called, first founded in 2015 when the market was having when a bubble was bursting then. They've been stepping in, and it's not been making a lot of difference, if the truth be told. It's interesting that it's small caps that are really taking a pasting. They're probably much more plugged into the local economy rather than the big multinationals. And what you tend to see, if you're looking at what the international investors hold, it seems like the Chinese banks, which are big, liquid, in theory safe, but they're also state-controlled, so then there are governance issues to address. So the real value is in the local stuff that's really getting hit. The governance risk is probably in the big, safer stuff where the international investors are hiding.
Now, it's we don't often see newspaper stories moving share prices these days, but it's happened this morning with the FT splash.
Yeah, big thumbs up for the pink paper today. A big splash on Lloyds Bank and Banco Santander of Spain allegedly helping Iran to move money around through a very complex web of companies. Both firms have said we're obviously in the business of abiding by sanctions, and we can't disclose any individual customer details, thank you very much. But clearly under the microscope, remember Standard Chartered was fined $1 billion, UniCredit was more than $1 billion of Italy for sanctions busting. So these banks will be looking at what's been going on, and the regulators will be getting involved as well.
Yeah, I remember talking to Standard Chartered at the time about that. They were absolutely furious because I think it was something like 10 trades out of a total of several billion.
Well, and again, it's through what looks like, and the FT's put a fantastic graphic up there showing this web of organisations that's being used to move the money around. So I'm sure it's not been easy to spot. But the good news is Lloyds and Santander are both well capitalised, but the shares are down. And if you look at Lloyds, since PPI, remember that back in 2011, it has paid out £30 billion worth of regulatory fines. It's given £20 billion back to shareholders. I guess if these fines come through, maybe it'll slow down the scope for more buybacks and a dividend increase.
Yeah, quite stunning. What about Vodafone? They updated the market today. I mean, no real fireworks.
No, I mean, the shares are back where they were in 1998, before the tech, media and telecoms bubble, which tells you what the market thinks. I mean, yeah, the slowdown in Germany isn't helpful. There are pockets that are going well, like cloud, so data storage remotely, but they're a minnow then compared to Amazon or Google or Microsoft. So little bits are going well. A lot of what really investors are looking for now, will there be any corporate activity? Relatively new boss, Margherita Della Valle, she's looked for a merger in Italy. She's looking for a merger in the UK with Three to try and create some cost-cutting scope and also get what she calls more rational pricing. Now, the regulator will look at that and think, does that mean price increases? And Vodafone have said no. But I don't see how you can necessarily have the one without the other, if the truth be told.
Well, yeah, they're not covering their cost of capital here in the UK.
No, they're not. And if one thing, you know, the regulator gets a lot of grief, but if you look at BT's share price back where it was in the 80s, Vodafone's where it was in the 90s, this is probably a market where the regulator is, you know, probably winning and the consumer is winning. It's the shareholders who are probably losing.
Yeah, Russ, we've got to leave it there, I'm afraid. Always good
Pleasure.
to catch up with you. Thanks for
you.
coming in. Still to come here on Business Live, why London has been judged as the most attractive city for cross-border investment, beating Paris, Madrid and Amsterdam. Stay with us.
I'm Alex Crawford and I'm Sky's special correspondent based in Istanbul.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, the UK's commercial property market has retained its status as Europe's top cross-border investment destination, according to a widely followed survey published this morning. The 2024 European Investor Intention Survey from CBRE, the world's largest commercial real estate services and investment firm, found that European investors have the highest return expectations for the UK for the second consecutive year, followed by Germany and Poland. Meanwhile, London was judged the most attractive city for cross-border investment, followed by Paris, Madrid and Amsterdam. Well, joining me now to talk about this is Chris Brett. He's Managing Director of European Capital Markets at CBRE. Chris, morning to you. Why is the UK seen as delivering the highest investment returns?
Well, good morning, Ian. I think one of the reasons is that we certainly saw in 2023 that the UK repriced quicker than other markets around the world. And you feel that more than anywhere in London. And London has often been a global receptor of international capital around the world. And with that repricing, investors are seeing the opportunity to get into the London market and indeed the wider UK market at a price point that it hasn't seen for quite some time.
I mean, you've identified more broadly an uptick in optimism among investors this year. Is that all down to interest rate expectations?
I think interest rate expectations certainly has a big factor to play when you look at the markets. But what I would just say, in the last couple of weeks, I've been in both the Middle East and I've been in the US, and the investor sentiment from those geographies is looking to be more positive in the real estate markets. Aside from the fact of interest rates, I think people are really seeing the opportunity to get into prime, grade A, opportunistic assets at really good pricing at a point in the cycle we haven't seen because of high interest rates. So this is really a moment in time, as I said before, that investors are seeing there's a real opportunity.
What about access to financing?
Well, I mean, clearly access to financing is at a slightly higher point, but I would say in January already this year, we've started to see both banks and alternative lenders show more appetite for the sector. And that's really because while short-term rates are quite high, long-term rates have come in, and real estate is looking, with durable income streams, to be an attractive opportunity again.
It's fair to say, though, that loan-to-value ratios have come down.
They have, and we would say today that probably 40 to 50% is a prudent loan-to-value rate across the markets, whereas pre-interest rate rises, that was much higher.
One thing that I thought was particularly interesting that you alighted on, Chris, is that logistics and residential are now seen as more attractive than office. Why do you think that is?
Well, I think, we could talk for a long time about the story of the office, particularly in a post-pandemic world. What you see from both logistics and from residential in all its forms is a durable income stream which has longer term and has proved to be more has got greater appetite, I should say, to the investor community. Longer leases in place with better credit than you're seeing in some of the office markets, which have had their challenges.
And yet, if I look around London, which has been identified as the most attractive city in your survey, I mean, there's still lots of office space being added. Capacity is being added to, despite the fact that here in the city, it's a graveyard on a Friday.
Well, I think you see a real bifurcation, Ian, in any major city around the world between what are the prime assets in a city and what are the secondary assets in a city. I think your point around Friday being a graveyard is perhaps slightly unfair because we didn't used to measure Fridays, if you remember, pre-pandemic. And when you look at the return to office in both London and the other European markets, it's leading the way in terms of on a global scale.
And Chris, why is Poland moving up the attractiveness list?
Again, I think I'm going to come back to my point around durable income streams and really population growth in Poland. It's really pushed at logistics and, again, residential. Poland is also a market that has repriced in a very deep way, and people are seeing that there is an opportunity to buy into that market at a price they haven't seen since pre-pandemic, pre-interest rate rises.
How much have prices come down in Poland, Chris?
Between 30 and 50% on average, Ian, and that's across the board, whether you're looking at retail, office, logistics, or indeed residential.
Wow, that's a stunning depreciation. Chris, got to leave it there. Good to talk to you this morning. Thank you.
Thank you for having me.
That's it from me for the time being. I'll be back, of course, with our afternoon edition of Business Live at 4:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Jane Secker with all the latest from Stormont. We're expecting the Taoiseach, Leah Varadkar, to be speaking very imminently. Do stay tuned for that. I'll see you later on. Thanks for joining me this morning. Cheerio.